Hi there, it's Geoff here with another video looking at preparation for the 2024 Edexcel paper. This time, paper 2, the macroeconomics. If it's okay with you in our time together, let's spend a few minutes working through 3 examples of possible questions, a 10, a 12 and a 15 mark question to related macro points. Quick reminder that in the 10, the 12 and 15 and of course the 25 we move to levels of response marking. Normally for a 10 marker, 6 KA for evaluation. Normally you can make 2 points, 2 KA points and 2 paragraphs, 2 short evaluation paragraphs. Sometimes it'll say just 1 point needed, and the second KA point is essentially the diagram. So read the question carefully to see what is called for there. 12 marks, super similar really, 8 KA for evaluation, so a bit of extra analysis needed, and normally it's 2 KA paragraphs plus a diagram there, 2 separate but short evaluation points. And then the 15 marker, 9 KA, 1 extra, 6 evaluation, so we're looking for 2 separate evaluation points with a little bit more detail. And obviously as we get higher marks, we're looking for extra links in the chains of reasoning. I'll work through with you in this diagram some examples of chains of reasoning. KA, of course, stands for knowledge, application, and analysis. But for these questions, the 10, the 12, the 15, no introductions needed, no conclusions needed. Whereas the 25 mark question, you're looking to make 2 separate KA paragraphs. Nearly always a good diagram there to support the analysis and the evaluation. 2 separate and developed evaluation points. And a final reasoned judgment is needed for the highest evaluation marks. So let's work through, if it's okay with you, 3 questions. Here's the first one. It's to do with inflation. There's a chart showing monthly inflation rates in a selection of developed and emerging countries from 2021 through to the end of 2023. And the World Bank's saying that in 2022, the summer of 2022, global inflation climbed to its highest level since the mid-1990s. And you can see that on the chart, can't you? It then began to subside, but it remains above the pre-pandemic average. Here's a 10-mark question. With the use of an appropriate diagram, assess one likely external cause of inflation for countries such as those shown in the chart. So, thinking about KA, we only have to build really one point. My strong advice would be probably take the external factor would be something like an increase in the price of global food or commodities, components or energy. So obviously in 2022 we saw that a substantial jump in world food and energy prices, which of course then caused a burst of cost push inflation. So that would be one factor to think about. The alternative would be a fall in the exchange rate, a fall in the external value of a currency. Sudden depreciation can amplify the cost, can increase the price of imports. So you'd really be using a cost push inflation diagram here along with aggregate supply. This is a neoclassical model, and with cost push inflation is caused by any factor, an external factor that leads to an inward shift of short run aggregate supply, causing an increase in the general price level and a fall in real output. You can then develop it a little bit by saying that there could be a wage price response as well. So after the initial inflationary shock, for example, a big rise in world gas prices, you might then get a wage response as well, which causes a further rise in inflation. And we certainly saw that in many countries, including the UK. So there's your diagram. Evaluation points. Well, the impact, the extent to which external cause of inflation depends really on whether the external shock is temporary or transitory or semi-permanent. And what we found in 2022 was the inflationary shock essentially was transitory because world gas and oil prices have come down, although world food prices have not fallen. And in fact, in some cases, things like the world price of cocoa continues to rise. And that's the sort of shock effect of the climate change now really starting to feed through to world food prices. So I suppose the impact on inflation depends on whether it's a short-term, short-lived external shock or more semi-permanent. It also depends on the country's trade patterns. The UK, for example, is a net importer of oil, so therefore, and also food, a net importer of food and gas and oil and what have you. And that had a big effect on our inflation rate, whereas other countries might be more self-dependent. They might have their own sources of food. They might be an oil exporter. It also depends on the exchange rate regime. It also depends on what happens to the exchange rate as an evaluation point. Here's the pound sterling against the US dollar from May 2020 through to March of 2024. Recent data. And can you see there that during 2021-22, the pound was falling against the dollar from about 140 down as low as 105 in response to the September 2022 budget. But that fall in the pound amplified the inflation shock because of a weakening or depreciating currency causes import prices to go up, especially those priced in dollars. Now, the pound has strengthened since then. It's gone back up towards 125, 130, which again has been a factor helping to cause disinflation in the UK economy. Let's look at a 12-mark question. A related question, really. It's about inflation and interest rates. Here's your chart showing the monthly inflation rate for the UK in blue. And the other bit of the chart, the black line there, is the central bank interest rate, the policy interest rate set by the Bank of England. Major central banks around the world tightened monetary policy in response to rising inflation. In the UK, interest rates were increased from 0.1% in December 2021 to 5.25% in August 23, and they remain at that level at the time of recording. So here's a practice 12-mark question. Assess the extent to which a rise in interest rates can help reduce inflation. Now, you might want to press the pause button at any time and have a go at this question. Think about what you'd include in your answer. And if you want to do that, press the pause button and then just press play when you want us to walk through the possible answer. So assess the extent to which a rise in interest rates, such as in the UK, can help reduce inflation. We're looking here for two analysis points. So the obvious one, I guess, will be to talk about the impact of an increase in the cost of borrowing on household spending and saving. So credit card costs will go up, the cost of mortgages goes up, and of course the incentive to save may also increase depending on the real interest rate. But at a time of rising inflation, people are looking for higher interest rate accounts to hedge against inflation. Businesses may invest less, planned investment may fall, and of course investment's a component of demand. So weaker consumer spending, more saving, perhaps less investment would reduce the growth of aggregate demand and hopefully close the output gap. Talk about that in a second. And also, really importantly, a really good KA point will be the impact of rising interest rates on the exchange rate. Let me walk you through stepping stones. Stepping stones is a nice little way of thinking about how to build chains of reasoning into your answer. So we're looking for this link, causal link, between higher interest rates and a fall in demand pull inflation. So rising interest rates, such as the increase in interest rates in the UK, is a tightening of monetary policy. Ceteris paribus, other things remaining the same. This can cause a fall in effective disposable income. That's income after tax and benefits and also after mortgage payments. So if mortgages become more expensive, people have less money to spend each month. This then leads to a fall in real consumer spending and aggregate demand. By the way, these little phrases in red here are great little connective words to really clarify your chain of reasoning. As a result, a positive output gap may be closed. Consequently, there will be a fall in demand pull inflation. You might want to put an extra link in there about the fact that weaker demand makes firms less likely to raise their prices because demand becomes more price elastic, consumers become more price sensitive, and so on and so forth. But there's a nice little connective chain there. A second connective chain could be to do with the impact of interest rates on the exchange rate and then inflation. So higher interest rates in the UK can lead to a currency appreciation. And this is because relatively higher interest rates in the UK might attract those inflows of hot money looking for the best risk-adjusted rate of return. Stronger exchange rate causes the UK prices of imported components and raw materials priced in dollars to drop. Strong pound, imports cheaper. As a result, there might be an outward shift of short-run aggregate supply, and consequently there will be a fall in cost push inflation. So higher interest rates might work through the exchange rate and appreciation of the currency to help cause disinflation. Evaluation points. We're looking for 2 points. Only need 2 for a 12 marker. Well, the impact of higher interest rates depends in part on the interest elasticity of demand. Are consumers sensitive to, responsive to higher borrowing costs, or do they just carry on spending as before, or don't change their saving behaviour? It also, of course, crucially depends on what's causing the inflation. You see, inflation is multi-causal. There are many causes of inflation, and interest rates might target, for example, demand pull inflation, but there could be other factors affecting rising prices. Mention what they are. And also, I think a really good evaluation point is to talk about the role for fiscal policy and other interventions. So price caps, subsidies, energy price caps, £2 cap on bus fares, and so on and so forth. Sometimes government intervention through price regulation, the regime that they set for setting rail fares, for example, on water bills, could be used to control inflation. And also other interventions, including public sector pay policy, pay rises for teachers and nurses, for example. 12 marks done. 15 mark. Let's have a look at a 15 mark question. To what extent is a rise in net inward migration helpful for the UK to achieve macroeconomic objectives? Now, this is an interesting chart. It shows the it's a moving average. So it's the last, each bit is the last 12 months showing migration figures into the UK. The blue line shows people coming in. Obviously, in the late part of 2022 into 2023, it peaked at over 1 million people coming in across the year. Over the rolling figure for the year is over 1 million. The black line is the number of people leaving the UK, emigration, and net migration, which is in the question, is the balance between the blue and the black line. And you can see that in the last couple of years, net migration has surged above 500,000 per year. In fact, it was about 670,000, I think, in the latest figures. So to what extent is net migration of over 600,000 people helpful for the UK economy? Let's just think about some of the possible chains of reasoning here. Well, one argument would be that this can lead to an increase in the UK's labour supply, particularly if this is a migration of people of working age who are looking to or have a job to come to. So this can help to overcome shortages of skilled labour in industries such as construction, health and social care. As always at Tutor 2, we love that phrase, such as. It's likely to get you application marks if you use it in the exam. You don't need to know the data on construction and health and social care, but there are clearly two sectors that have found it hard to get the skilled labour. As a result, connective phrase there, businesses will be able to expand production to help meet increasing aggregate demand. And this will cause an expansion of aggregate supply in the short run. Consequently, there could be faster growth of GDP, helping the UK to avoid a downturn or recession. There's a nice example there of a chain of reasoning saying that migration would be beneficial for the labour supply and for growth. By the way, as always in these videos, if you like what you see, take a screen grab, add them to your notes. So lots of things you could talk about. Possible impact on short-term supply, possible impact on the trend rate of growth. Does a rise in migration increase the potential output of the economy? What are the potential consequences for productivity? But also lots of students would choose other macro objectives. You only need to choose 2 for your KA points. So I've talked about growth. Other students might talk about inflation, possible demand pull inflation. What does migration do for the government's own fiscal position? Does it increase or decrease the deficit? And what might migration do for the rate of unemployment, as well as the employment rate in the economy? Here will be a classic diagram to use. I'm using a Keynesian diagram here, arguing that an increase in skilled migration, particularly younger people with skills and qualifications who have a job, can cause an outward shift of aggregate supply and an increase in aggregate demand. And so in theory, migration can help sustain non-inflationary growth. But evaluation points. We know there's been this chart, of course, shows the level of migration in and out and net, but it doesn't tell us some of the detail that could be super important. So are these short or long-term flows? How long are people who come into the UK staying for? What are their ages? What are their backgrounds? What are their skills, their experience and their qualifications? What's the kind of quality of human capital? What about the impacts of this level of migration for the demands placed on public services, education, healthcare, housing? What's the impact on the rented sector and so on and so forth? How might this level of migration impact on domestic workers in terms of their employment and their real wages? And critically, I guess, the role of work visa policies. Now we've left the European Union single market, the government's brought in a work visa policy, which in theory tilts migration towards higher skilled, higher paid jobs. Not always. A lot of this data, I think we include students in this data. So the big fall in migration in 2020, of course, a lot of students weren't able to return to the UK for their studies because of lockdown and the pandemic. And the big rise in migration in the last year or two, in large part, has been hundreds of thousands of students coming back to the UK. Do they stay here? Do they contribute to the economy? What happens to the hundreds of thousands of students? What about the impact of that on the finances of the universities themselves? So on and so forth. Huge amounts to talk about here. In a 15 marker, just pick out 2 possible macro objectives and then 2 evaluation points. You don't need a conclusion for a 15 marker. Now, I could easily ask exactly the same question and make it a 25 marker, in which case you would be looking for a final reasoned conclusion and also making a bit more use of the data. There we go. We've been through a 10, a 12 and a 15 mark question in preparation for paper 2. I hope you found it useful, and if you did, please consider pressing the like button and subscribing to our channel. Loads more exam support, our daily revision sessions. Check out our live streams for revision, live group revision across different subjects. It'd be fantastic to have you there. For now, thank you for joining in the video. Stay safe, stay healthy, stay happy, stay curious, and see you sometime soon.